Good afternoon, everybody, and welcome to another Hamilton Wealth Partners Fund Manager webinar. My name is Kane Baranow, and I'm a principal at Hamilton Wealth Partners. The format for today's webinar will be the same as previous webinars, and I'll begin by reading a brief advice warning, then I'll introduce our guest speaker, and then we'll open up for questions at the end. But do feel free to submit any questions in the taskbar below throughout the webinar. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking into account your objectives, financial situation, or needs. You should, before you make any decisions regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether that is appropriate, having regard to your objectives, financial situation, and needs. So today I'll be joined by Stephen Arnold from Aoris Investment Management. Before founding Aoris in 2017, Stephen was head of international equities at Evans and Partners. He directly managed $1 billion worth of client assets, and over 6.5 years, he generated investment returns that were in the top decile of a broad group of international funds. So with that introduction, I'd like to hand over to Steve. So over to you, Steve.
Well, great, Kane. Thanks very much for that introduction. Thanks for having us on the webinar today, and thanks everyone else for your interest in what we're doing. As Kane said, I'm the founder and CIO of Aoris Investment Management. I've got more than a quarter century experience in global equity markets. A couple of features about Aoris that might interest you. Look, first and foremost, we're an independent business. I've always had a clear view that the best equity managers in the world, certainly the best ones that I've ever come across, have all been independent businesses. So we were glad to set ourselves up as an independent business. Second, I'm a big believer in focus. We're here to do one thing well, and we're a single strategy manager. We're also a capacity aware manager. We know that there's a quantum of money that one can manage that somewhat becomes unwieldy. Sometimes size can be the enemy of good returns. So we've said from the outset that we've got capacity limits. And the third foundational principle, if you like, is simplicity. We're a big believer in keeping things as simple as possible, our business and our investing. I'd probably add a fourth one. We're a big believer in transparency. You can see every stock we own on our website. You can click through and see what the companies do. Click on some corporate videos. So we really lift the hood and show what we do and why we do it. Our investment approach is a simple one. We're all about being business owners. And the types of businesses we want to own are those that become more valuable over time through sustainable, durable profit growth. We also want to own businesses where the risk of a disappointing outcome is low and the consequence of disappointment is low. And when we can find businesses like that, and those quality hurdles are very high, when we can find them, price matters. We want to buy our interest in those businesses at some discount to what we think that they're worth. That all sounds very generic. So, what is it that we do authentically different? How do we end up with a very different portfolio and different client outcomes? Well, the first thing is we're very concentrated by only 15 stocks. It allows us to keep our hurdles very high. So we're unusually concentrated. We're a fully invested manager. We want to have every dollar of capital in those quality businesses we own. We don't take cash levels up and down to express views on the market. We try and invest in businesses where the externalities matter as little as possible. If who wins the November election in the US matters to a particular business, we'd rather not own it because we're never going to be experts in making those predictions. Likewise, interest rates, commodity prices, employment levels, trade friction, Brexit, GDP levels, and so on. Where that matters, it's in our too hard basket. So we say no to large parts of the market that many other managers are comfortable owning. Let's put some numbers around that. We target returns through the cycle of 8 to 12% per annum over time after fees. And you'll see that the bulk of that outcome, it comes from the wealth creation of these good businesses. And I like to break it down, if you like, into 4 cylinders. So the first of those is good businesses grow profitably. They don't stand still, tread water, or go backwards, they grow. But you don't need turbocharged growth, at least in our view. So 4% nominal GDP or more is a good threshold, but it doesn't need to have an extra digit in there. It doesn't need to be 40%. Good businesses generate cash, and good management do sensible things with their capital through making bolt-on acquisitions, share repurchases, and that's going to add another 2 to 3%. So there's a 6 to 7% of, if you like, upward trajectory in capital value of these businesses. Of course, they'll pay a dividend to us along the way. We think that'll add another 1 to 2%. And price will contribute as well, to the extent that we own them at some discount to fair value. We think across the portfolio today, that discount's about 15%. If that closes over 5 years, that'll add another 2 to 3%. So while some managers, they want all the work to be done by one of those cylinders, it's all got to come from growth, it's all got to come from dividends, it's all got to come from revaluation. We like to have a balanced contribution, modest contributions from each of those 4 cylinders. And there's the 8 to 12%, with the bulk of the outcome being driven by wealth creation of high quality businesses. Now, it's very easy to put in a PowerPoint presentation, but if, like most managers, we get half of our decisions wrong, we'll end up with something that looks a lot less than 8 to 12%. So we measure this. Some people call it a batting average. Some people call it a success rate. We call it repeatability. What it measures is what percentage of stocks have we owned that have outperformed the market during the period we've owned them. It might be 1 year, it might be 3 years. Now, you might be interested to know that only 3% of managers get more than 53% of the stock calls right. It's not a great endorsement of the whole notion of active management, but there you are, that's the stats. But for us, 68% since the inception of Aoris of stocks we've owned have outperformed the market, and at Evans & Partners was about 3/4. So you can see that we've statistically got most of our stock calls right. What matters, of course, also is the other side of that coin. The stocks that don't outperform, how do they go? And we measure that as well. And the way we think about it is, what percentage of stocks have we owned that have been in the bottom 20% of the market during the period we've owned them? We call that the market disaster zone. Now, if we have 1 in 5 of our stocks in that bottom 20%, that would be entirely average. But we've had 0. Over my time at Evans & Partners was also 0. And just to put a statistic out there for you, the likelihood of achieving that outcome by chance is less than 1 in 10,000. So that all comes from disciplined, rigorous, common sense investment approach, and with high hurdle rates in terms of the types of businesses we want to own, and being also disciplined about what we don't own. Let's spend a moment more about what we avoid, because that goes a long way to achieving the outcomes that we've generated. Now, how do we avoid that bottom 20%? Well, it starts with the characteristics, the financial attributes of businesses that we say no to. Businesses with low levels of profitability, they're not the wealth creators we're after. So they're out. We're a conservative manager. We know that people come to us with capital. Our priority, of course, is to protect that capital. So high levels of financial gearing, we say no to those as well. You might be interested to know that there's no variable that's more statistically correlated with negative share price returns than rapid balance sheet growth. That's the M&A junkies. Sadly, Australia's more than punched above its weight in terms of destructive M&A over the last couple of decades. So we still steer well clear of those companies that are growing rapidly, aggressively. And also price matters. If you pay a silly price, you should expect to end up with a disappointing outcome. There's plenty of sectors of the market that simply don't have the attributes that we're looking for. So, we stay well clear of them as well. You might be interested to know that if you pick a resources company at random, it's 80% more likely to end up in that bottom 20% than a company drawn randomly across the broader market. So there's good reasons for that. They're simply not great wealth creators. The returns on capital through the cycle are poor, very cyclical, very dependent upon those externalities, the commodity prices, and all of the M&A tends to happen at the top of the cycle. Now, banks and insurers are also outside of our comfort zone. They're in our too hard basket all the time. I was the banks analyst at Goldman Sachs in London during the 10 years I spent there through the GFC. It was really very much the epicenter of the crisis, along with New York. And one of the memories that's deeply embedded in my recollection is on a Saturday morning watching Australia play Wales in rugby in the country with some friends, and at halftime the coverage crossed to the queues of people outside Northern Rock, which was the largest mortgage lender, independent mortgage lender in the UK at the time, people queuing to get their money out. And of course, the circularity of banks meant that the fact that they were queuing created the crisis of confidence, and the bank never reopened on Monday. That was it. it really brought home how fragile these businesses are, how dependent on externalities such as liquid capital markets, interest rates, government regulation that they are. So for us, they're in our too hard basket. We're pretty wary as well as government regulation, which the way I think about it, it's moving goalposts, and that very much applies to industries like telecommunications, utilities, and healthcare, where the government will affect how the supply chain works, how you can price, reimbursement rates, allocation of 5G spectrum, who can build your network, are we pro-coal, anti-coal? We want businesses that are in charge of their own destiny. So where government regulation matters, that's also in our too hard basket. Let's talk for a moment about these engines of corporate wealth creation, of sustainable, durable profit growth. Now, we like to own businesses where size and scale is a huge inherent advantage. Now, there's lots of industries where that's simply not the case. I don't think the biggest airline in the world is necessarily the best airline. If you ask General Motors and Volkswagen, does being the biggest auto company make you a better one? I think the answer is unequivocally no. Likewise, Deutsche Bank would probably concede that being the biggest bank with the biggest balance sheet is probably not the best way to create wealth. But there are industries where size does matter, and that's what gets us interested. We like businesses where there's some technical, engineering, and scientific expertise that's simply very difficult to replicate. We also like businesses where there's some direct relationship engagement with their customers, particularly where it's a technical one, rather than selling through an intermediary like a retailer or a wholesaler. If you sell direct, that's a big advantage. Even better than selling to your customer's procurement department, where the conversation is almost always about price. If you can sell to a user, a technical user, it's much more about value, solutions, what problems that you're having that we can solve, and it's simply a better place to be. Then how the capital structure, how the business is financed, how it's managed, the culture, the customer centricity all matters. Is the business run with good ESG principles? We're a firm believer that good behaviour is good business. And that'll all generate the sort of outcomes on the right-hand side. High customer retention rates, a variable we pay a lot of attention to. Good businesses win. They outgrow their peers, they gain market share, they generate high returns on capital, and they grow profitably. Should also add, we like businesses with breadth. We're a concentrated manager, but breadth matters. Rather than having a portfolio of what I call one-legged stools, businesses that do one thing, we like businesses with breadth, and that provides robustness and durability. Here's our portfolio. I said we're transparent. Here it is in its entirety. And we like businesses that provide essential products and services to other businesses. When it comes to consumer businesses on the right-hand side, we like those that are structurally advantaged in growing markets, like a Costco, like a Nike or L'Oreal. Just to give you 10 seconds on a few of these wonderful businesses that you might know less well. Cintas, America's largest uniform rental company, a great example of being the biggest is a huge advantage. Jack Henry, a provider of essential banking software to small banks and credit unions in the United States. Experian, the world's largest credit bureau. MSCI, you'd know, is the index and data business, almost a toll gate on international equity investing. Let's bring three of these businesses to life. You might know Accenture, a great example of where size and scale matters, combined with technical expertise and a direct engagement with their customers at the very highest level, I should add. They certainly don't sell to the procurement department. It's very much at the board level. They are the largest IT outsourcing consulting business. They're sweet spots, the world's 2,000 largest organizations. And for those companies, those organizations, having an IT provider who does business everywhere they do business in 180 countries around the world and provides a breadth of capabilities across ERP, cybersecurity, e-commerce, IT outsourcing, and so on, is a huge advantage. It saves a client from sort of creating a patchwork of different providers. They have an incredible depth and durability of client relationships. 98 of those customers have been customers for more than a decade. They have 200 customers that spend more than $175 million a year with them. Just to give you a sense of the kind of quantum of these relationships. And that's all. They've done a great job of evolving over time, little by little to stay relevant to their customers. Unlike, say, a Hewlett-Packard or an IBM that sort of treads water, goes backwards, and then tries to do a transformational acquisition to catch up. Accenture has never drifted behind because they've made small acquisitions to bring essential capabilities, retrained people, hired people. And that all really came to the fore in their last quarterly result in the middle of the year, right in the middle of COVID, where their bookings were up 6% year over year in a crisis period where so many companies were seeing big consulting projects cancelled or deferred. That's led to 10 years of consistent market share gains and high levels of sustainable profit growth. Nike, we all know what they do. Many of you might have enjoyed the Netflix series, The Last Dance. I enjoyed watching it with my 14-year-old son. He loves his Nike, except he's got fat feet and he's got to wear New Balance shoes. But he's a big fan of the brand. They are the largest in what they do. It's a huge, huge advantage. They're 40% larger than Adidas. Would you believe they're 7 times the size of Under Armour, which, by the way, is money and going backwards at a rapid rate. And that size allows Nike to make big investments across a huge sales base in their e-commerce, where the market's rapidly moving. In the last quarterly result, which they released 2 nights ago, 30% of the sales are already online, and that's got to that point 3 years ahead of schedule. Huge investments in product innovation, manufacturing, distribution, supply chain. It produces loyal customers, means that Nike doesn't have to discount as much as their peers, keeps profit margins high, creates that money to reinvest back into the business. And that flywheel has created year by year, 10 years of consistent profitable market share gains. It's been an amazing story. And as I said, when they reported their results just 2 nights ago, the business is absolutely firing. Look, I'm a firm believer that through this COVID period, all the challenges in 2020 are amplifying the differences between the great businesses and everybody else. And that's what we're all about as managers. We want to own the best businesses. We're not interested in the second or third best. And in this period, the advantages of being the best is really coming to the fore. And Nike and Accenture are seeing the gaps between them and their peers really widen up. Nordstrom, less well-known business, of course. They're a great example, though, of a business where this direct technical relationship, what we sometimes call a white coat to white coat relationship with their customers and users, is a huge, huge advantage. It's really the secret sauce of this business. They're the world leader in precision dispensing of fluids and adhesives and test and inspection equipment. Inside your mobile phone, if you give it a shake, it doesn't rattle around. That's because all the components inside are glued together. And Nordstrom is the reason that happens. It's a very, very technical, highly engineered process. In consumer packaged goods, a good example is nappies. Procter & Gamble makes nappies, and Nordstrom bonds and injects, sprays glue into the product itself. Too much of it, and it's not very comfortable. Too little of it, and it all falls apart, and that's bad news for mum and dad. And at the end of that production line, there's a cardboard box that's got to be folded and bonded together. And really the secret sauce of this business is those 3,000 engineers that Nordstrom have that sit side by side with their customers, help ensure that their products are being used optimally, keep the manufacturing process ticking along at a high rate. And they hear directly from their customers what products that you have. You're trying to create a waterproof phone, a foldable phone. Here's how we can help you solve that problem. What we really like is where we own a business and we've seen another high quality company try and compete directly with it. We actually own another company that does many things well, and they tried to compete with Nordstrom directly in this market, and they got nowhere. It's a really a great attestation, if you like, of the formidable barriers to entry this business has. And that's produced 54 consecutive years of dividend increases, would you believe, and very high rates of profit growth. So we said wealth creation comes from sustainable profit growth, and here it is. Over the last 10 years, those 3 businesses have grown their EBIT line organically or without any help from acquisitions at a rate of 8 to 10%. And that reinvestment of free cash in share repurchases and buybacks has added another 2 to 4%. A dividend yield's given us about 1.5%. And so you can see profit growth at the top line there of 10% plus, and total wealth creation, if you like, of 12 to 15%. That's the engines of wealth creation that we want to be owners of. There you see all the companies in our portfolio, all of whom have generated earnings growth over a 10-year period superior to that of the broader market. In fact, if you took an average across the portfolio, it's probably 2 or 3 times that of the broader market. So some nice long-term profit growth from the businesses we own today. Of course, it's all about what lies ahead. Can they continue to deliver it? And we feel that's very much the case. Not only growth is important to us, but resilience matters a great deal as well. And the way we measure that is to bring to life those 2 colours there. The blue lines show over a 10-year period the return on capital these businesses generate. And we said wealth creation comes from high returns on capital, and that provides the engine for growth. Those blue lines are all comfortably above that red horizontal line, let's call it the cost of capital. Over the far right-hand side, you can see the MSCI index has got a light blue line of about 6%, and not that exciting. What's important here, though, is that in 2009, which we show there in orange, the returns on capital for all of our companies remained above that cost of capital. Doesn't mean earnings didn't decline, but they remained highly profitable. Whereas on the far right, you can see that wasn't the case for the broader market. So right now we're going through a whole new stress test. We'll have a new set of data next year. But for the GSC, it shows that we own all weather businesses, not fair weather businesses. I should mention that if we took the ASX 20 companies from 2009, even though Australia remarkably was the one OECD country that didn't have a technical recession, I think something like 11 of the ASX 20 companies at the time cut their dividend, and about 13 of them had equity capital raisings, which reflected that they didn't have great balance sheets going into that period. For those of you who are interested, Morningstar's given us a very high rating for our ESG credentials. We talked about the types of businesses we don't own, the resource companies, banks, much of healthcare, automotive, and so on and so on. And of their rating system, 5 globes is as high as you can get. In fact, in a very broad universe of Morningstar international funds, we rank in the top 1%. So in summary, hopefully I brought to life our investment process. We really try and keep it as common sense as possible, simple, but execute it with a lot of discipline and rigor. It produces a very different portfolio of businesses, some of the world's highest quality businesses in our view, but quite different from what you'd see from many other managers. We work, as I said, very hard to not only show what we own, but explain why we own them. And in our investor communication through this last 6 or 9 month period, we found the feedback we've got is it's produced a lot of comfort from investors. People understand what they own and why we do what we do, why we own those businesses, and it's helped them to stay the path, stay the course through this year. So with that, I'd be delighted, Kane, to answer any questions that you might have.
Great, thanks. Thank you very much for that, Steve. I might get started with one. You spoke about how, the COVID environment, it's amplified the benefits of great businesses over average businesses. Just with respect to the whole COVID environment, did you have to make any portfolio changes? And if you did how quickly did you respond?
That's a great question, Kane. In a normal year, I would expect that we'd sell 3 or 4 companies and buy 3 or 4. Through to the end of August, we've sold 2 and bought 2. So I'd say it's a reasonably normal rate. In March of this year, we sold a global catering business, not too dissimilar from Spotless in Australia, called Compass Group. And in May, we sold LVMates, a luxury goods business. So let me just touch on both of those. So for Compass Group, when we look back over prior recessions, the business had proved very resilient. They provide meal catering services to people at sporting events, places of work, schools, universities, and so on and so on. So it's been a very resilient business. But as we came into the COVID period, the business is being very materially and very directly impacted by the shutdowns. As you can imagine, people aren't going to all of the places that Compass provides food. And so we sold it late in March. And I'd say that in hindsight, we're about a month slow in joining the dots and recognising that the the work from home orders in the Northern Hemisphere, the cancellation of sporting events was going to have a pretty meaningful impact on their business. So we sold it. It's been a good sale. The business has genuinely struggled since we sold it. And importantly, we recycled that capital dollar for dollar into MSCI, the index business, not the index itself, the index company. And it's been a very, very successful investment. So that's one, as I said, one we, in hindsight, would have liked to have sold a little bit earlier. LVMH, that business was doing fine up until the point that we sold it. But as we looked forward, we recognised that people travelling for leisure is an important driver of their business. About half of the Louis Vuitton brand sales go to people travelling internationally for fun, and the travel restrictions is having a very meaningful impact on travel volumes through their stores. They also sell primarily through their own stores rather than department stores, which creates a pretty significant lease burden through their P&L, and it's a fixed cost, not a variable cost, and that amplifies. Great business, much to admire, but one we'd rather have out of the portfolio for a couple of years until we can feel that this COVID period is genuinely well behind us, and we'll take a fresh look at that company.
Okay, thank you for that. You spoke a bit about some of the changes you've made, and there's obviously clear winners and losers from COVID. More on a theme level, a macro sort of theme level. Can you identify what some of these winners are likely to be and what some of the losers are likely to be, and have you sort of positioned for that going forward?
Yeah, Kane, look, I think we feel pretty broadly happy about the principles that we'll always invest with have served us well through this period. Being fully invested and not taking cash up and down has served us well. Not owning banks, energy companies, opaque businesses where it's challenging to understand how they're performing. So transparency is helpful. We say no to a lot of interesting sounding businesses where we just can't penetrate the layers and understand them. It's helped us stay the course with businesses that might have been going through a challenging few months because we understood what they do and could be confident in the long-term merits of owning them. So when we think about what we stay away from, look, I think the transition away from traditional oil users, if you like, auto transportation may be accelerating. People might just work from home. I don't need to drive as much. Certainly it's having a pretty depressing impact on oil prices through this year. So that's always in our too hard basket. Likewise, banks that are dealing with lower interest rate spreads, that might keep pressure on their P&L for an extended period of time. So all of those industries where we'll always not own them has served us well. And then owning the winners, just to pick one other one, Cintas, the uniform rental business, they reported last night. They're a business that in the middle part of the year, it looked like that business would be a really, if you like, a COVID casualty. Uniform rental services to manufacturing environments, restaurants, hotels, all of those businesses, those customers under a lot of pressure. But by being the leader, it's provided huge advantage to them. They have a purchasing scale and supply chain that has allowed them to procure essential products to their customers that their competitors simply cannot get hold of. One of the big non-uniform services that they provide is hand sanitizers and cleaning services, scrubs and gowns to hospitals, and all of which are in short supply. And by being the leader in their market, they're at the front of the queue, and they are absolutely essential to their customers actually opening the doors and operating. And so that's an example, another example of amplifying the benefits of being the leader, amplifying the competitive gaps between the best businesses and the rest. It's not only size, it's all of the other softer attributes that go with it. The long-term thinking of management, the customer centricity, creates a lot of goodwill. So in the case of Cintas, they've got a lot of customers that can't pay. I can't pay this month. And by being accommodating with those customers creates a lot of goodwill. And when those customers do reopen, they want to do more business with Cintas. So those are, if you like, some of the attributes. In terms of losers, of course, we don't own businesses in travel and entertainment. Businesses like Disney are under a lot of pressure and with huge fixed cost, a lot of financial gearing in that business post their recent acquisitions, cruise lines, commercial real estate businesses, all those sectors under a lot of pressure this year, and that pressure might be long lasting.
Great, thank you. I've got a question here from Michael. COVID-19 was an out of left field event. Has this given you any concerns with the extent of your concentration? And a related question, why do you think 15 is the correct number? And maybe just to go with this question, just maybe if you could talk a little bit on your internal diversification and how you approach diversification.
Yeah, thanks, Kane. In terms of comfort levels with concentration, like it's a way I've been investing for the last 9 years and never felt uncomfortable doing it. And through this period, I think it's been a benefit, if anything. We think we can make our best decisions if we make fewer of them. We can put a lot of rigor, a lot of thought into each business. We can know each business we own a lot better than if we own 30, 40, 50, 80 of them. And if you own 80 businesses and you replace a quarter of your portfolio every year, you need 20 new ones. We need 3 or 4 new ones a year. So the rigor and the discipline, the due diligence behind each investment decision, I think, is a lot more exacting than would be the case if we own more companies. It's also meant that in times of stress this year, where there's a lot of uncertainties, it's allowed us to, I think, think a lot harder about businesses we own and be comfortable staying the course with them, rather than panicking because we don't know as much as we'd like to know, which might be the case if we own more businesses. I think the key is to have an investment approach that works well for you. And this is not an approach that clearly works well for many people, but it works well for us, and it has done for a long period of time. As Kane said, what matters a lot is the breadth and diversification across individual businesses. You mentioned many of them. Accenture serves companies from every slice of the economy in 180 countries around the world. And at some points, resources are hot, banks are soft, automotive customers are soft, data center customers are hot, and that natural diversification is a huge advantage for them. Cintas, they serve a huge variety of healthcare. The healthcare industry is one of their largest end markets, and right now it's super hot, but it's only 7% of their sales. And a business like Nike, they have one brand, but they do it in every country in the world. So internal breadth and diversification, this sense of multi-legged stools, and where we can look back over many years and see the customer's been successful, business has been successful, grown profitably, taken market share, been a winning business. We're not interested in turnarounds, businesses that have had many years of poor performance and a couple of years of turnaround, and that's never going to be interesting to us. So one other interesting part of our concentration, just to finish off on that, is we have a hard ceiling at 15. Many managers say, oh, well, it'll be 20 to 30, maybe a bit more than that, but with no defined limit. By having a hard limit, it works very well for us. It keeps the process simple. If we own 15 stocks, we know the next one has got to come at the expense of our least preferred stock, as opposed to, it's always easier to add than subtract. It's easy to add to, and now we're 17 and add a few more. It's always harder to replace and to sell. By having a hard ceiling, very much in keeping with our simplistic process, we want to keep things as simple as possible, and we know where the hard ceiling is. And if we own 15, it's got to be one in, one out. It works well for us.
No, thank you for that. You're clearly a bottom-up fundamental, investor. You've used words like, owning businesses and investing in companies. What disciplines have you learnt over the years to avoid, the market noise and to, avoid speculating and to ensure that you are following that fundamental process?
It's a great question there, and I enjoy answering it because it's so interesting. And I thought you've absolutely got to the essence of what we do. We are business owners. We use the word owning all the time. If you were to spend a day in our office, we'd hear it a lot. And I think that's why our philosophy resonates well with people whose wealth is being created in one form or another through successful businesses. In fact, where the world's great fortunes been made, they've been made through successful businesses, and that's what we're all about. I'm a big believer in creating feedback loops. It's almost like a scientific discipline of self-learning. And if I think about all the points over my many years where I've had views on the markets, they would have almost all been wrong. I would have, whether it's views on the Australian dollar or views on interest rates. In fact, I wrote a piece about 10 years ago, shortly after the GFC, about why super low interest rates at the time would only go up. You might, after a year, you might say, well, you'll be right in time. And after 10 years, I was absolutely wrong. I think I wrote a piece about why China's economy in 2012 was built on very shaky foundations, but the economy, of course, has continued to grow. So I think that there's a sense of humility, recognising where you've had views and you've been wrong. And that's why we choose not to express those views in our portfolio. Of course, we think hard about the world and what's changing, why things are as they are, but also recognise that where we can add our best value is by owning successful businesses, not expressing views on interest rates or commodity prices or political outcomes, of course. In fact, I remember back, even the experts are probably not as helpful as you might think. In 2011, I remember having a conversation with Total, the large energy company in France, and the person I was speaking to there expressed very authoritatively why oil would never fall below $100. And then it halved and halved again, and it's never been close to $100 since. So, they don't know, I don't know. So we'll steer clear of expressing those views in our portfolio and just own great businesses like a Nike and Accenture.
Thank you. I've got another question from Michael here. So in a COVID world, given you can't travel, you can't leave your state, are you concerned that you can't actually go to visit these companies and kick the tires, for the foreseeable future?
Well, it's a great question as well. I think what we've been positively surprised with over the last 6 months is how much we can do in the absence of traveling. The frequency, the number of interactions we've had with companies has been significantly higher in the last 6 months than 6 months before. We get very good access. Just this morning, we had a conversation with the CFO of a portfolio company, Amphenol. Just to give you the 15 seconds, they're a world leader in providing connectors, little devices that join electrical circuits, and you'll find them pretty much everywhere there's electricity. And so that's great. We get good access. We learn a lot. We continue to identify new interesting businesses and engage with management as part of our discovery process. But we do miss traveling. Just to get when I was last at Amphenol, they're based in a little sort of roadside head office in Connecticut. I was meeting with the CFO and the CEO walked in. And of course that kind of, those instances like that just don't happen over the phone. And the CEO walked in, spent 10 minutes in the meeting. And those 10 minutes brought to life the culture of the business in a way that I just never heard brought to life before. Because he's the embodiment, the champion of the organization's culture. And he just loves it. So that was a really valuable 10 minutes that wasn't scheduled in the diary. He was good enough to invest his time. So we miss interactions like that, but we've been very pleased about what we've been able to accomplish just over the phone in the absence of traveling.
Thank you. I've got a question here from Stuart. He's asked, which valuation methodology do you focus on most? So multiples based or discounted cash flow analysis?
Oh, another great question, and it really enjoyed exploring, just how we think about what a business is worth. What we don't do is discounting future cash flows, because I've seen a lot of DCFs, and I've never seen a recession embodied in a DCF before, and they tend to hardwire in optimism bias. We know that we're human, and we know that humans are wired optimistically, and it's far too easy to put rosy assumptions in there. And I think the whole DCF methodology was described to me once as being a bit like the Hubble telescope. You move it an inch and you're in a different galaxy. And that's very much like the discount rate. So what we do is we value cash earnings, not accounting earnings. And there's really what shows up in the P&L is an imperfect representation of economic reality. We try and get a bit closer to economic reality by thinking about, like, after a company has spent money on its working capital, after a company has spent money on its CapEx, because that's necessary for the company to grow. We're interested in growing businesses. Well, what's left for shareholders? And the higher your return on capital, the more a dollar of accounting earnings translates to a dollar of cash earnings. And we're only interested in business with high returns on capital. So that's we value cash earnings. We value 12-month trailing earnings. And we think hard, what are the two independent variables then? It's risk or quality, two sides of the same coin, and growth. So we make thoughtful, hopefully conservative assumptions about how to incorporate our subjective view of growth and risk into our valuation, derive a multiple, and apply that to cash earnings. We value every business the same. A dollar of cash is a dollar of cash. And I find that this approach works well for the types of businesses we're interested in. But I think it doesn't work well for average or below average businesses. I don't know how to value a B grade industrial business or a bank or a shrinking company. This methodology, I think, works very well for the high quality growing sorts of businesses we want to own. And that's where we apply it.
Okay, thank you. I've got a couple more quick ones. So given you look for hard to replicate advantages that businesses have, so technical or scientific, where possible, has there been any instances of that advantage being lost? And if so, what risks do you manage for in the portfolio to avoid these occurrences?
Yeah, look, it's another great question. And because our starting point is the world's best business, the risk, the direction of travel is always going to be negative, if you like, a reversion to the mean. We're hyper vigilant against big moats getting smaller. It's a very, very dangerous place. And that can happen a few ways. It can happen through management neglect. Companies that think, look, we own our market, the job's done. And then they get complacent, or they get arrogant, or they get expansionist, and we're now going to enter new markets and show them how it's done. So there's a lot of, if you like, subjective assessment. We pay a lot of attention to how management talks. We pay a lot of attention to what management does. To give you an example, Nordstrom, which we talked about a year ago, they introduced a new CEO who came from outside the company. So we'll put a lot of effort into making a judgment. Is this CEO going to understand what makes this business special? And is he going to reinvest behind it, preserve and protect and reinforce what's special about this business? And we had a 1 hour call with him shortly after he was appointed, which gave us a lot of comfort. And then in all of the earnings calls since then, there's been a very, very strong, very, very consistent message that what makes Nordstrom special is its technical expertise. And the magic of this business is our direct technical interaction with our customers. And that's what we're going to reinforce. And acquisitions are going to be modest. They're not going to take us into different markets. So we've been reassured there, but we do put, if you like, we're hyper vigilant in detecting signs that there's leakage, slippage, competitively or through management neglect that might shrink these big moats.
Okay, thank you. And just lastly, you've got a ceiling on the number of companies you'll own in your fund. You also have a ceiling on the amount of money that you'll end up managing.
We do, and we also have a ceiling on the size that an individual position can represent in the portfolio, which is 10%. Like in terms of size, I think that size can be the enemy of performance. That there's a quantum of money where it's just hard to you're fishing from a smaller and smaller pool of liquid stocks. Or alternatively, you own more and more stocks, and if your starting point was we can do our best job owning 50 stocks, and then 10 years down the track you own 150, it's probably because you want to manage more money, not generate great outcomes for your clients. So we've been pretty thoughtful about that in setting ourselves up. We've been very public about it. We put it in a document we have on our website called our Owner's Manual. We put these flags in public view. We've said, based on how we understand liquidity today, which might change, we think that if we're owning a 15 stock portfolio, $3 to $5 billion is where it'll max out at. And as we grow, we may never get there, but as we grow, we'll make a more refined assessment about where those limits actually are. But based on how we can see it today, that's where those parameters are. And I think it's a bit like, I think if you want to get a bit fitter, but you tell no one about it, no one that you have particular goals to lose weight or run a bit faster, then it's easy to kind of not do it. But if you tell your family and friends, you're far more likely to stay the course. So we've been very deliberate about putting these principles and parameters right there in public view to hold ourselves accountable to it, and to know, for everyone else to know, what our aspirations are, what our disciplines are, so people can make a more informed judgment about what we are as a manager.
Great. Well, there's no more questions. So thank you very much for your time today, Steve, and everybody for listening at home. I hope you gained some valuable insights and enjoyed hearing about Aoris. If you've got any further questions or would like more information on Aoris, then please feel free to contact us and we'll be happy to help. Do keep an eye out for another invitation to our next fund manager webinar, which will be going out early next month. And yeah, thank you again for listening, and I hope you enjoy the rest of your day.
Thanks very much, Kane. Thank you, everyone.